Okay, that was a late-minute addition. If we go back to the topic that's on everybody's minds, the economy, tariffs, and all that, this morning you might have seen China imposed 125% tariffs on the United States in retaliation for the 145% tariffs that the United States has on China. The Chinese also announced that they would not be raising tariffs any more than 125%. And indeed, if the United States raised tariffs beyond what it has today, they should be the laughingstock of the world. So it does look like the Chinese are trolling the U.S. a little bit while raising tariffs to match the United States, which makes them just as dumb as America. Well, not quite as dumb, but almost as dumb as the American government is. But anyway, basically what we're seeing here is, as we said yesterday, the decoupling of the two economies, the halting of trade between the two economies. Nobody's going to be paying 100% premium on the stuff they get from China, or 100% premium. Chinese are not going to buy stuff from America with 100% premium. So it basically is going to shut down trade between China and the United States, and the consequence of that are going to be interesting. We're going to be keeping an eye on that. But in the meantime, financial markets are behaving, let's say, strangely, but in a way that I think is consistent with a certain attitude towards America that's happening right now. And that is, by the way, the stock market was up 2% today, I guess because the Chinese said they're not going to raise any more than the 125. I don't know. I don't know why the market was up 2% today, but it was. But what was interesting in today, the last few days, is that interest rates were up again. So the 10-year bond was up. I think it was, what was it, over, let me just find it here. It was, it's at 4.49. So it's basically at 4.5%. Remember, it was down to below 3.9 at some point just last week. So it's been a huge increase in interest rates on the 10-year over just a few days. Some of the largest increases we've ever seen in history, or at least modern history, in terms of moves in interest rate. At the same, now, usually what happens, when interest rates go up on a 10-year bond in the United States, usually the dollar gets stronger. Because why? Because people want to buy these bonds because they're getting a great yield on them. They're getting 4.5%, and that's better than they can get elsewhere in the world. So, and they need dollars in order to do that. So they go out and buy dollars, and then they go buy these bonds at these high interest rates. What's interesting right now is that the dollar is going down as interest rates are going up. The dollar is going down as tariffs are going up. Remember, I gave you the whole thing about why increasing tariffs increases the value of the dollar in normal times. What does this all indicate? I think what this indicates is that foreigners do not want to hold less dollars. They want to hold less dollars because they want to invest less in the United States. They're not buying our bonds. They're not buying dollars in order to invest in other American assets. They're selling dollars, and they're selling American bonds. What this basically is a expression of very low confidence in the U.S. economy, in the U.S. more broadly, in U.S. financial assets. The euro right now is above 1.13, close to 1.14. It was over 1.14 at some point, but it came down a little bit, but it's still very high. These are some of the highest levels they've had in 3 years. The dollar has lost about 5.5% of its value since so-called Liberation Day. We've also seen the pound sterling go up in value significantly. We've also seen the yen, the Japanese yen, go up a lot. Yen was at 160 to the dollar, and it's down to 143, I think, to the dollar. So all of this is indicative of the fact that even though people know they're going to be selling less to the United States and getting less dollars that way, they're not going out and buying dollars. They're not buying dollars in order to buy American bonds at 4.5%. There's a lot less appetite for dollars. Now, this is not the dollar collapsing. This is not the end of the world, not yet anyway. We'll see if it lands up being how bad it lands up being. But there's going to be a lot of hysteria out there about the end of the world. It's not. But it is concerning, and it is something to watch, and it is interesting because if you look at a graph of interest rates as reflected by the 10-year and a graph of the dollar, the value of the dollar versus a basket of goods, they usually track one another. And the idea that they're going in opposite directions is unusual. And again, something to be watched. And we'll see what kind of economic implications. I'll also add to this, which is consistent with the idea that the value of the dollar is declining in international markets, that gold is up. And you could think of gold going up, or you could think of the dollar in terms of gold going down. That is, it takes more and more and more dollars now to buy an ounce of gold, which means the value of the dollar is declining. It's declining vis-a-vis other currencies, and it's declining vis-a-vis gold. Now, I don't know if this is kind of the beginning of the end of the dollar as the reserve currency of the world, or the beginning of the end of the dollars as having significant value. The challenge I think people are going to have as they engage in this trade is if they're not going to hold dollars, what are they going to hold? If they don't trust the United States anymore, who do they trust? Now, yeah, you can hold yen, and the Japanese government's pretty stable and consistent, but the Japanese economy is not growing. Do you really want to be investing in Japanese assets? Probably not. You can get the euro. Euro's pretty stable. It's going up in value right now. But do you really want to be investing in European assets? Germany is in recession. Yeah, it's going to do this big fiscal stimulus. It's going to invest in its infrastructure, and if it's going to invest in its military. Is that going to create economic growth? Is that opportunities for investment? Not clear. It could be that after a while, in spite of all the problems, in spite of all the nuttiness, in spite of all the insanity, people come to the conclusion, in spite of everything, yeah, I mean, the United States is maybe just as bad or not as bad as the alternatives that they face. I don't know. But that is certainly a possibility of how a lot of this gets reversed, is that people realize that other countries in many ways are worse. I mean, one of the things that characterizes the United States is that often, in spite of the insanity, irrationality of its leadership, of its political leadership, its business environment, its entrepreneurial environment allows for many political mistakes, and somehow the U.S. economy still does okay in spite of all of them. Now, whether that happens now, I don't know, but it's always a possibility. So I'm not quite ready to be the guy who says, okay, it's the end of the U.S. economy. It's all doom and gloom now. We're finished. We're done. I don't think that's the reality. I really don't. But, as I said, something to watch.